All right, good morning, everyone. Well, Tuesday was the reverse of Monday, with U.S. 10-year bond yields falling back to 2.88% and implied rates on Fed fund futures retreating as well. The dollar was generally weaker against both G10 and emerging market currencies. Even the beleaguered Indian rupee managed to regain ground against the dollar, although the Indonesian rupiah continued to weaken. Among the G10 currencies, the three commodity currencies and the Norwegian kroner were weaker versus the dollar, probably owing to indications of less tightening to come. For example, the much lower than expected second quarter GDP report for Norway. Also, the Reserve Bank of New Zealand said that new lending curbs could reduce house price inflation in half. There was some interesting action in the Swiss franc. Euro-dollar managed to break out of its recent trading range and move above 134, the figure, even as peripheral bond spreads widened. Spain versus Germany was up 12 basis points, for example. German Finance Minister Schäuble's admission that Greece will need a third bailout should also have depressed the euro, but it didn't. Nonetheless, and this is the point I want to get to, the Swiss franc strengthened against the euro, as well as against the dollar, too. It looks to me like it's likely that some of the money flowing out of the emerging market currencies is naturally looking for a safer home, and Swiss franc would, of course, be one of the major possibilities there. So I'm looking for the Swiss franc to strengthen further as concerns over the emerging market, over the health of the emerging market intensifies. Now, going back to the dollar, the pendulum could swing back the other way and the dollar get a boost later today when the Fed releases the minutes from its July 30 and 31st FOMC meeting. This will provide details of the discussion that led all the Fed officials to such strong conviction that September will see the start of tapering off of quantitative easing. I expect the minutes to reaffirm this conclusion and therefore to send U.S. rates up higher, boosting the dollar again and sending emerging market currencies lower. Then overnight, we get the HSBC market flash manufacturing PMI for China for August. While this isn't the official PMI, this one is closely watched. In fact, some people believe it has a better reputation than the official PMI. It's expected to rise to 48.2 from 47.7, well, which would still be showing a contraction in manufacturing, but less of a contraction. That could help the Australian dollar to recover. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.